Start.
Yeah, I think you guys can already go ahead and start.
Let's call the meeting to order. Do you take a roll?
Yes. Mhm. Member Sleeth, absent. Members Colnick,
Here.
Chair Hill.
Here.
I'm sorry, Vice Chair Colnick. Chair Hill.
Here.
Members Jane will be running late. Member Brickley.
Here.
Mayor Holland would be here soon. And then Councilmember Whitmer. Great, thank you.
The first item is
I guess, public comment, sorry. Yeah.
Is there anyone online?
I don't think so. Nobody that wants to do it right now.
No, sorry about that.
Second item is reviewing and approving the draft minutes of the January 13th meeting. Does anyone have any injury addition? A motion to approve the minutes.
Motion to approve the minutes.
I'll second it. All those in favor?
Aye.
The next item will be presentation on CalPERS, and Robert, you want to introduce our guest?
Yes, thank you, Chair Hill. Yes, as the committee has been aware, we've been reviewing our CalPERS actuarial pension regularly, consistently over the last several years, and discussed changes, we contributed some ADPs, 3 million this past fiscal year and 24-25. We also did one again back in 2022 of 5 million. And then we study all the different updates that CalPERS has done. We're here today is Ira, I'm sorry, Summer. Ira Summer, I didn't want to mess it up. Ira Summer from True Crump. And Ira and I, we've been in discussions in several months on CalPERS and our OPEB, our pension liability. The True Crump has a pension modeling software. They came out with it first, and then CalPERS had their pension outlook tool. So Ira's very familiar. His company True Crump is very familiar with the modeling of pensions, and then also they model our OPEB as well. And he's here to kind of show us and discuss the changes of the CalPERS assumptions that have taken place lately. Funding statuses within plans, the impacts of additional contributions of the pension, and then investment returns. So we provide a forward-looking projection on what it looks like with the CalPERS various updates. Ira has a presentation, and then the cool thing is he's going to go through and model the pension software tool that has all our information updated for in this software tool. Ira even updated the ADP in there, and so he's going to go through that after he goes through his presentation. So without further ado, I'll turn it over to Ira. Thanks for being here, Ira. Appreciate it.
Thanks for having me. And thanks for making nice weather for me to have. Not too hot, not too cold. It's really great. Actually, little background. Just first of all, I've got a presentation set up. I talk about this stuff every day. I'm pretty sure you people have real lives, so you don't do this every day. So I'm here basically the beginning is education and to answer questions that you have. So if as I'm going through this, you've got questions, ask me the questions, stop me. I don't want to lose you on slide 3 and go through all of this and then having to go back because you missed everything that was going on. And a little bit about my background. I was a consulting actuary for about 35 years for public agencies across the country. Spent a couple of those years as the auditing actuary for CalPERS. So I'm intimately familiar with how CalPERS does things, how agencies across the country do all those things. After about 35 years of that, I got released for good behavior and went off to teach finance and economics to MBAs. But The thing about public finance is once you start working in the public finance area, they never let you leave. So they put me back in, and I've been doing this for the last 10 years with what used to be GovInvest and is now TrueCom. So we're going to focus on the pension area today. Again, I have this PowerPoint here. I'm going to go through sort of 4 sections. First, I'm going to start off with the basics. I always like to start out with the basics because even though I talk about this stuff every day, most of you are not necessarily spending your entire career focusing on the intricacies of funding and CalPERS and how it works. Then I'm going to talk about how your pension fund here at Atherton compares to other agencies across California based on the most recent valuation reports produced by CalPERS, then talks about what's changed since those last valuation reports and show you the impact of those changes and where things look like moving forward, and then talk about your unfunded liability and addressing it. I also have, after this, I'll show you the software, and we can run through scenarios if you have certain things you want to talk about and look at and see the impact of as we go through them. In terms of the basics, the math itself, relatively complicated, but it all comes down to one simple thing. It's basically getting to understanding that the money coming into CalPERS is supposed to be enough to cover the money going out of CalPERS. They do that based on your people and your benefits. You have 2 safety benefit structures. So for those who are hired 2012 and earlier, you're in what's they refer to as the classic safety plan, is the 3% of 50. What that means is if somebody started working here at age 25 and they retire at age 50, they've got 25 years of service, 25 years times 3%, 75%. They get 75% of their final pay every month for the rest of their lives. The final pay is based on, as it says here, 12 months. So that's the highest consecutive 12-month period throughout their career. It's usually the last 12 months, but not always the last 12 months. They are required to make employee contributions into the plan of 9% of their pay. And the benefit comes with a cost of living adjustment, which I'm summarizing here as 2% per year. But what it really is it's retiree benefits get adjusted with inflation up to 2%. So if inflation is only 1%, they get a 1% COLA. If inflation is 2, they get 2. If inflation is 3, they still get limited to 2% COLA. So that basically controls your costs. For those hired 2013 and later, they're in what's referred to as the PEPRA formula. PEPRA stands for Public Employee Pension Reform Act. It was passed by the Brown administration, the most recent Brown administration, in 2012. It did a few things. One of the things it did is it created a single benefit structure for safety and one for miscellaneous, which is the non-safety people. The one for safety is the 2.7 to 57. So every safety officer in every agency throughout California has the same benefits. So you're not trying to get a slightly better benefit structure than Menlo Park or Santa Clara County or someone else to try and stop them from stealing your officers away. It's based on highest 36-month pay, or highest consecutive 36-month pay. And the employee contributions are set at what's referred to as 50% of normal cost. Normal cost is an actuarial term that refers to the cost of each year of service as it's earned. So basically for each year of service as it's earned, the cost is split, half of it to the township, half of it to the employee. Past liabilities all paid for by the town of Atherton. For your non-safety members, which are referred to as miscellaneous, the classic members are in a 2% of 65 formula. So people hired 2012.
Sorry, it's 55. I didn't update it. Yeah,
2% of 55.
Yeah.
Sorry. Okay. And I don't have my glasses on.
No, you're
I
good.
probably could have said 55 and I would have noticed. But the current PEPRA formula is 2% of 62. And that's the same formula again for all agencies throughout the state. Normal cost again, the employee contributions are currently 8.25% of pay. So it's for people hired 2013 and later, the benefits are slightly less, the employee contribution is slightly higher. So what's going to happen with your costs over time is that the normal cost, so the cost for each year of service as it's earned, is slowly going to be decreasing. Right now, it's averaging about 16% of pay. is going to be coming down and averaging closer to about 12 over the next 15 to 20 years. As your population shifts, as your longer service people leave, they're more expensive, new people get hired, they come into the lower cost plan. And this portion of your cost is going to be slightly better controlled over time.
So, if, when people change jobs and they move and they were classic, you know, at their previous job. And let's say the contribution, because of maybe some trading of salary versus what the employee contribution was different than it is here. How does that get averaged out?
Okay, if you hire somebody from another agency within California,
Right,
now let's break this into two categories. You hire somebody now, and let's say they started working. Let's make the easy case. They started working in 2020, so they don't have that much service. They were PEPRA in the other plan. They're PEPRA for you. Their employee contributions get calculated. Employee contributions get calculated this way. Their total pension, you're responsible for their total pension based on their service with their time with Atherton. And again, if they leave Atherton and they go to Menlo Park or Palo Alto, and they keep staying in the public sector, their final compensation for all of their pensions are based on their total final compensation with all agencies throughout California. So that part of it ends out rising. But the employee contributions stay the same, and your costs are basically calculated based on just for the service they had with you. If you hired somebody who had started in 2010 someplace else, when they come to work for you, they go into the classic formula.
right, yeah, but if there was, my question is the employee contribution.
Employee contribution rates,
So we've
It's-
done some things here where traded salary for employee contribution. And how does that match based on, let's say, a guy from Menlo Park coming over where they didn't do that?
you have your deal for your employees. So the contribution rate's 8.25%.
Right,
If in your collective bargaining agreement, you say that you're paying the first 3% of that,
Okay.
then that's what you're doing. That's part of the collective bargaining.
and as they move along, then each section is.
And as soon as they go someplace else, that's part of their total compensation package, and they've agreed to go someplace else.
Okay.
And that's on.
Great, thanks.
Another question.
Just want to get a better understanding of this 50% of normal costs. It looks to me like this is a defined benefit plan with a mandatory employee contribution part. Is that kind of how this is?
That is what it is, yes.
So it's not 401k-ish because they're not elective, but,
No,
and then what I don't kind of, so somebody who comes into the 9%, what I understand from the classic versus the PEPRA is that PEPRA is a cost containment or cost to us.
yeah, to actually
How does it
every
do that
agency
when
across the.
So what it does is it says, instead of contributing 9, you're gonna contribute 14.5, so 5.5% more. What's this 50% of normal cost?
Okay, so when the actuarial assumptions change across time, for the classic members in the safety, because you're obviously looking at the
They're
safety
fixed.
members, they're playing fixed 9%. When the actuarial assumptions change for the PEPRA people, the contribution rate might change. So if they lower their assumed rate of return right now is 6.8. If they lowered it to, let's just say 6, what would happen is the normal cost, the cost for each year of service would go up because less money is expected from investment return, more money is required from you and them. The normal cost would go up. Their contribution rate would go up at that point in time.
So it causes them to assume part of the liability.
Right. And when
But it's
CalPERS,
not based on their age, it's based on the rate of return of the underlying portfolio.
it's yes, but okay, it's not based on their current age. It's actually based on the average age of hire for all the people in the plan.
That's
Because
true.
the normal cost is basically a cost to pay from the time they get hired to the time they leave.
And that's not necessarily just our group, that's all of.
This is for, because you are one of the smaller agencies throughout California, you're in what CalPERS refers to as the risk pool. So what they do for all the small agencies in the risk pool is they take all your demographics, they combine them all together. And and then they come out with a cost. So all of the 3% of 50 plans that for agencies in the risk pool all cost exactly the same normal cost. And then they adjust the unfunded liability payments based on how well funded you are across them.
This gets triggered every year, right? Is that?
Every year, CalPERS does an actual evaluation report. They take a look at this again. Most of the time, the normal costs, the assumptions don't change. The normal cost doesn't change. Demographics don't shift significantly because, again, this is a huge pool of agencies across the state. But
People that are.
But, and one of the things I'm going to talk about is the fact that every 4 years under the law, the CalPERS is required to assess what's its experience and relook at their actuarial assumptions and make some adjustments across time. They did that recently. I'm going to talk about what they did. The changes aren't very big and the rates are going to end up staying relatively the same.
So the two safety officers that are living this life are, one of them's like, hey, I'm always 9%. They know what their outgo is.
Yeah.
The other one is I'm 14.5, but I get a change every year.
Well, yeah,
It's not that
and
material,
they probably change small
Something
amounts
like
and
$20,
they probably change every 4 years.
Okay.
Yeah, the rates change about every 4 years.
Yeah.
So that's when we.
Okay. Question?
Yeah, when someone retires that has worked for different agencies, then a retired person regardless is going to be in someone's accrued liability.
Actually, if they're in multiple agencies,
Yeah.
they're in multiple accrued liabilities.
Or some percentage based on,
It's if they spent 10 years at Menlo Park and 10 years here,
Yeah.
then half of, and let's assume you have the same benefit formula, then half their liability is there and half of it's here.
However, let's say Menlo Park hired, or Atherton hired them as a office specialist. But when they retired in Menlo Park, from Menlo Park, they retired as the highest paid employee in the
management.
organization.
Right, but because of, and the reciprocity, which is this thing I was talking about before, where if you move with it from one agency in California to another, this is something that's been in place, I think, since the 1960s, in order to encourage people to stay in the public sector. Your final pay is based on your final pay in whatever the agency is that's the biggest. So you might have had them as a clerical person, and they didn't give you a whole lot of value at that point. I mean, they were a great clerical person. They were obviously good enough that Menlo Park would hire them away and then put them in charge of Menlo Park because, being in charge of Menlo Park is not the same as being a clerical person here. And so.
This is being recorded.
But only for Atherton, right? Can't get out of town. So their pension ends up being based on that high pay that they end up getting paid.
What happens to our?
And your liability, the amount you're paying for their service there is based on that higher pay later.
Correct, so we're shorted.
So, yeah, if they gave them a huge pay increase, you end up with an unfunded liability got created because your good people got hired away by somebody else.
and so it's just allocated on years of service, nothing else.
It's allocated on years in service and benefit formula. Because they might have had a different benefit formula than you. So if I'm going to keep it simple, they had 10 years of the 2% benefit, or you had 10 years of the 2% benefit, and they had 10 years of the 3% benefit, they get 20% from you and 30% from them. So they allocate it that way, but it would still be based on the final compensation.
Thank you.
And that's how the classic plans were started.
That's also how
They were different formulas.
plans work. Yeah.
And that's why that we're just creating PEPRA, and everybody's state is having one formula only for those two groups.
Is that blind to new hires? When you bring them in, that's not a question you.
Oh, I'm pretty sure they know that they have reciprocity.
No, I mean, do we? So if I'm hiring you and I don't know that you've been 20 years making $300,000 somewhere, I'm going to bring you in here. Is that something we know? It just happened? Is that why you asked?
I'm pretty
No,
sure.
it's just, I asked the question because, I started out as a code enforcement officer, so that first agency, that first agency that I was paying into CalPERS, or they were paying into CalPERS, paid me at this amount. Now I'm the city manager here, so they're getting a little screwed, even though they have the same 2% at
They
55.
haven't been rooting for
That's
this.
okay. We don't mind that situation.
Right.
Yeah.
Right, so it creates that unfunded liability, for the organization, so
That's interesting.
So everybody we bring in from another agency starts out, we're bringing them in only as, junior level
Junior,
person.
yeah.
So let's just make sure that we've got that down now, George, okay?
That's funny.
Right, actually, the issue isn't so much when you bring them in. It's when they get stolen away and go someplace else, and somebody else pays them a premium to go someplace else. That's where this occurs. And the thought process is, on average, it should balance out, but not necessarily for any individual agency. So. Other questions? Okay, so that's the basic background stuff. So now let's talk about how your agency is doing relative to other agencies. And when I talk about that, I tend to focus on two metrics. One is the funded percentage. It's your assets divided by your liabilities. Basically saying how close to being on target are you with your funding. We do this plan assets divided by plan liabilities calculated as of June 30, 2024. The reason we picked June 30, 2024 is because that's the date of the most recent actuarial valuation report released by CalPERS. CalPERS released the June 30, 2024 valuation reports in August of 2025. Those are the reports that determine the contributions you're required to make to CalPERS for the upcoming 26-27 fiscal year. The second measure is total contribution percentage. So it is the total contribution you're expected to pay in the upcoming 26-27 year divided by expected pensionable compensation during that year, so that I can do a sort of apples to apples comparison for big agencies and small agencies, looking at it as a percentage of pay. And even though I'm doing the required contributions, the contributions themselves are broken down into two pieces when they get created. There's the normal cost piece, that I keep using that term over and over again. It's the cost for each year of service as it's earned. It is set up as a percentage of pay. And so you pay each pay period by that percentage. The other second piece is to catch up to get you to 100% funded. Spoiler alert, you're not 100% funded. Other spoiler alert, almost nobody in California is 100% funded right now. So there's an unfunded liability amortization payment. That payment is a dollar amount that gets set each year. It gets adjusted each year as experience is different than what was expected. If its experience was worse than what was expected, then the unfunded liability goes up and you end up having a new series of payments tacked on top of it. If it was better than expected, it comes down into credit and you end up getting that credit across time. The combination is the required contribution of CalPERS. That's the minimum amount that you can make to CalPERS. When CalPERS asks you for this money, you are required to make that payment. Proposition 162, the Pension Protection Act of 1992, set it up so that CalPERS picks the actuary and the board set the assumptions, they set the costs. As soon as they ask you for it, that's a required payment. And if you decide you don't want to make that payment, they go to court and they can take it. It becomes top priority to take from your general fund first. But I think I've only seen two agencies in the history of CalPERS say we don't want to pay. And both of them found that they had to pay. So when we do this measure, I split it up into two categories. I'm measuring your miscellaneous plan against the other miscellaneous plans across the state, and the safety plan against the safety plan. So that, because the safety benefits, as we were seeing, slightly better, shorter careers. And so the liabilities end up shifting and the costs end up being a little bit higher for safety plans than they are for miscellaneous plans. So let's take a look at where you are. On the miscellaneous plan, for funded percentage, you're 69.9% funded, which it shows here that you're at the lower end. But the thing is, you're so close to 70. And 70 is where most of the agencies are in the low 70s. So you're very close to being right in the middle. You're a little below average for agencies throughout California.
I thought when we looked it up, we were in mid-70s.
Does this take into account the most recent?
It says 2025. I think it's.
This is June 30, 2024.
Yeah, so it doesn't take into account our more recent.
It doesn't take into account the extra 3 million you put in. I'll talk about that in just a little bit.
Yeah, because We've seen a different.
But we're putting it
But
in
this
the
is
public safety
miscellaneous,
plan.
yeah, this is.
Yeah.
And then this is the
Yeah.
miscellaneous plan, and the miscellaneous contribution
Okay,
is 33%, which puts you a little bit higher than average, but again, very close to the averages. For the safety plan, you're 82% funded.
okay.
Okay, that is, as you can see, better than most of the agencies throughout California. And because of that, because your unfunded liability is lower, your contribution, 50.7%, although it's much higher than it is for the miscellaneous plan, is still at the lower end of contribution rates for safety members throughout California. Safety members end up having a higher contribution rate because they both have a higher pension formula and they have a shorter career, so you have less time to make those contributions, and investment return doesn't do as much for you. You end up having to make the contributions yourself. So remember, all this was as of June 30, 2024. Bunch of things have happened since June 30, 2024. First of all, biggest thing driving all the costs, our investment return. CalPERS announced in July of 2025 that their return for the 24-25 year was 11.6%. That's the preliminary return. I'll talk about the difference between preliminary and final in just a second. This graph shows year by year what their investment returns have been across time. The purple bars are their investment returns in each year. The red line is their assumed rate of return. First of all, you'll notice that the assumed rate of return relatively steady compared to the actual returns, which were relatively steady during the 80s and 90s, but became extremely volatile once we hit 2000 for a variety of reasons. One of them is the markets as a whole became a lot more volatile since we hit 2000. The second is their asset allocation, their investments became more aggressive across time. And part of the reason for that is back when I first started doing work in the pension area, back at the beginning of this graph, early 80s, fixed income was earning 10%, 12%, slowly coming down. It was still even about 8-9% as we hit the end of the late 1990s. So you could have a basic 60% stock, 40% bond portfolio. The bond side of it would be earning 8-9%. You can get a solid return across time. But as the fixed income rates came down, as the Fed started lowering rates for things like the .com bubble burst, the Great Recession, and then COVID, and then whatever stupid things going to be happening moving on, what happened is we bring the fixed income down. CalPERS slowly moved their assumed rate of return down slightly. So it was 8.75 in the 1990s. Actually, back when I was the auditing actuary, we started lowering it down at that point. It's gone down to 6.8% right now. But that drop is not nearly as much as the fixed income drop would have done. And the way they kept it that way is becoming more aggressive in their investments across time, diversifying into international stocks and other things. And now they have about a third of their money in private equity, private debt, and real estate, which generally, and I'll show you in a little while how much, help with the returns, but they're a little bit, they're definitely not as liquid, so they're hard to value. So they like getting out information as fast as possible. So they get these preliminary numbers out in July of each year, and then they put final numbers out right before Thanksgiving. And the final numbers, and these are the ones that show up in the report, but the final numbers are the ones that actually get credited to your account. Good news is the last couple of years, investment returns have been strong. 9.3% for the year ending June 30, 2024. 11.6 was the preliminary number for the year ending June 30, 2025. If I just pretend nothing bad has happened in the last couple of months, CalPERS was actually up 10% as of February. And I have not looked at the markets today. But a bunch of that was gone as of earlier this week.
And how do you said when I looked, that's not something that we could look at.
What?
You said the rate of return year to date or whatever period you're talking about is 10%. Now it's changed. Where are you looking to see that?
First of all, I have spies at CalPERS.
Yeah.
Giving inside information. Second of all, if you go to the CalPERS website, you can find they show the asset value, the total asset value for all of CalPERS. They have whatever, $500 billion. You can, and again, I I checked this again by talking to their actuarial staff, but if you know what their asset value was as of June 30, 2025, and you see what the asset value is now, the cash flow in and out is pretty close to, is relatively close to zero. So you can get a pretty quick estimate of what the returns to date have been, and they tend to update that relatively regularly. So for those of us who don't really have a life, we can go on there and take a look at it on a regular basis.
I just didn't know it was that available.
Yeah, no, a lot of the CalPERS has done an amazing job. Every year they do a better job of disclosing more information and trying to be more helpful. It's difficult when you are administering the plan for 2,000 separate agencies, from small agencies like this through the state of California who have different needs and other things. So they provide information. They try and provide a lot of information, and if you want the information they provide, it's out there. And that's great. If you want other information, it's extremely difficult to get a hold of because they're just that big, and it takes a while to deal with those things.
That's very helpful, because we usually had no idea until they come up with their preliminary thing.
Yeah. And so, right, it's somebody's in the back room with dice just going, okay, this is what I'm going to tell people today. And so, yeah, a lot of information out there. Good news, again, better returns the last couple of years. More money from investment return means less money is going to be required from you. Because again, this all comes down to money in equals money out. More money is coming from investment return, the better it is for everybody.
How much of it is in real estate? Because real estate's not very liquid these days.
Real estate's not, again, I don't know, it's not quite 10%. I think it's more than 5%.
Yeah, because I read, I guess, a couple of years ago, they were starting to move into real estate.
Right, and again, they've gotten to a point right now where I think about a third of their portfolio is either private equity, private debt, or real estate.
Yeah.
So which gets the whole issue of finalizing their returns. So the final return was 12.1%. Preliminary was 11.6%, final was 12.1%. This graph shows you got the pink, which is the preliminary numbers over the last 10 years. The purple are the final numbers that they came up with.
So close.
And again, it's better returns. The private equity and the private debt tends to be in things like AI, medical technology, data centers. Most of those have been doing relatively well. So when the markets are doing well, and those are the things that have also been driving the big stock market gains, you see better years. On the other hand, like 2022, when all asset classes lost money and everything was losing money, they lost money even more. So it's no guarantee, but over time, it's given incremental value for this. So it's and because they have $500 million, $500 billion in assets, they get some of the best asset consultants helping them out through all of this process. So again, even those people tend to have biases and make mistakes, but overall they tend to do relatively well. The other thing I mentioned before, every 4 years under law, the CalPERS is required to reassess, take a look at their actual experience during that time period, and make recommendations to change their actuarial assumptions to better reflect where they expect to go in the future. Those assumptions basically fall into 2 categories. You've got economic assumptions, which are the ones related to money. Small changes in these areas can end up having a huge impact on your contribution rates. So things like the investment return, salary growth, inflation. The other side of the demographic ones, the assumptions related to people. There, it takes big movements in order to have much of a change on your contribution and your funded percentage. So those are things like when are your employees expected to retire, how many of your employees are projected to become disabled and collect benefits early, how long a retiree is expected to live, how many employees are actually expected to leave early and not take any of the town's money. If you leave with less than 5 years of service and don't go to another public agency, you get a refund of your contributions and none of the town's money. So they went through, they did this analysis, and sort of quick summary of what happened or didn't happen in some cases. The discount rate, they made no change. They're keeping it at 6.8%. They actually did make some changes to the asset allocation. So their assumed rate of return, so their investment consultants are now telling them they should expect over the long term to get a 7% return, but they decided to keep the assumed rate of return at 6.8. First of all, it provided a little bit of cushion. Second of all, because they just spent 25 years trying to get the assumed rate of return from 8.75 down to 6.8. They don't want to end up pushing it up and then bring it back down, because that's going to end up causing the employee contribution rates that sort of jump all over the place, and nobody's happy with that. So they're going to try and keep it steady for a little while. They did increase the assumed inflation assumption over the long term from 2.3% to 2.5%. So that's, inflation is going to be moving up. That's not going to have much of an impact, if any of an impact, on your retiree COLAs, because they're capped at 2%. They were expecting over the long term to average 2% cost of living adjustments for retirees. 2.5, it's still expected to get 2% there, so that's not going to have much of an impact. But with it, they bumped up the wage growth assumption. The wage growth assumption, they have two salary-related assumptions in place. The two used to be the same, but they split them up. The first one relates to how they project individual pay. So for individuals, they look at every single person that's in your plan. They look at what they're being paid right now, and they project out how long they expect them to stay and what they expect their pay to be at each point in time when they leave. So when they're projecting it out, their projected pay is a combination of an across-the-board pay increase plus longevity and promotion increases. Longevity and promotion increases are based on, since you're in the risk pool, all the California agencies throughout the state. So the across-the-board pay increases portion of this is increasing from 2.8% to 3.8% per year as the assumed average assumption over the next 30 years. The second piece of it, and that's the higher pay projected in the future, means higher benefits. Higher benefits means higher liability. That's going to increase your cost slightly. Second, the other assumption they have is a salary growth assumption. That is supposed to reflect your total payroll. And generally, the salary growth assumption and the wage growth assumption have been exactly the same. And the reason for that is we assume that you have the same number of employees moving into the future. And if across-the-board pay increases are 2.8% per year, and we have people in all the same positions, we expect total payroll to be growing about 2.8% per year. That makes sense. And if we moved it to 3, it makes sense to move it up to 3. And if they were doing this purely mathematically and not politically at all, that is exactly what they would have done. The thing is, this number is only used by CalPERS to amortize, to determine the amortization payments for unfunded liability that got created in 2019 and earlier. So unfunded liability got created 2019 and earlier is amortized as a percent of projected total payroll. So the payments go up by 2.8% per year. Unfunded liability got created since 2020 are level dollar payments each year. So they don't change at all. If they were to adjust this and move it up to 3.0, what would happen is your payments in the short term would go down, payments in the long term would go up. The plan would not get as well funded in the short term. And again, they've been working really hard to get all the agencies that they can into the 80+% range. Agencies have been moving forward pretty well. They don't want to backtrack by making lower payments over the next few years and pushing more of the cost into the future. So they kept this rate the same. From a political perspective, a funding perspective, this is a very smart move. From a mathematical perspective, this is what I call cheating. But it's effective in what it's supposed to do. Yes. What?
So I wondered, I understand how this works. And I've wondered about the rationale for it, because by this 2.8% inflation, you're still amortizing it over a certain period. It's just making current payments less and future payments more.
If you move it to 3, you make future payments less, and current payments less and future payments more. Yes.
Yeah, or if you went from if you went from zero.
Right, but the thing is, right, the thing is,
What's the rationale for doing that?
well, when they originally set this up, setting up the amortization this way as a percentage of pay, the normal cost was set up as a percentage of pay and growing with pay. Thank you. So they also wanted the total contributions to try and stay moving up as a percentage of pay across time. To try and keep it relatively consistent as a percentage of payroll across time, so that it would be easier to budget as a percentage of pay. So it'd be a consistent percentage of pay, moving forward into years.
But it's still amortized at 6.8%. And so you're shifting payments in the future, meaning you're gonna be.
Right,
essentially
and the thing is,
paying
they're doing less shifting now than they would, than they have in the past. They're doing less,
Okay.
but if they decided to switch to basically level dollar all of the payment unfunded liability amortization payments,
Yeah.
all the ones 2019 earlier,
Yeah.
all the contributions for all the agencies would jump up in the short term.
Right.
And while that would get plans better funded, it would hurt a lot of right now. And if they had done that, they should have done it like a couple years, when the market, when the economy was going strong and everybody had money, it might have been a great time to do it. But they didn't. And now that the economy is weakening and a lot of agencies are worrying about their budgets, it's the worst possible time to try and ask for more money and tell everybody you have to make more payments. So now if you wanted to make more payments, CalPERS if you want to give them extra money, you've already started doing it. You can do that. You can decide internally that you'd rather pay this off as a level dollar amount. And some agencies actually do that. They go to CalPERS, they say, we would like to re-amortize our unfunded liability. We'd like to do it as a level dollar amount, and we'd like to take these bases and re-amortize these payments. But once you do that, you're locked in at the new rates, and you can't undo what you did.
This is what I would call smoothing.
This is their approach
It's
to
a blend between the employer, the investment return, and trying to meet everybody's objective. The fund wants to get money early to earn more. The employee wants to give up the least amount and get the most out of it. So when you combine all these things together, it creates a certain defined benefit plan. But you got to smooth it, because otherwise it can be chaotic for someone.
Georgia, and I'm in a meeting.
right. And actually, this is one part of the smoothing that they do. The biggest thing they do to sort of limit volatility of contributions across time, as I started saying, every year when plan experience doesn't match the actuarial assumptions, you've got a new unfunded liability. It may be a positive unfunded liability to raise your costs. It may be a negative unfunded liability to give you credit. Most of your unfunded liability now is amortized just straight 20 years, consistent payments across time. Because the biggest cause of volatility is due to markets jumping up and down. So new unfunded liability got created due to investment returns being different than what they expected, anything different than 6.8. That actually has one more piece of smoothing on it. It's got what they call a ramp, a 5-year ramp. So in 2022, when the markets were way below, and you had this new unfunded liability, in fact, they were expecting, they assumed 6.8% return. They actually had a negative 7.5% return. So it's a 14.3% gap. Very big. That got phased in, ramped in over a 5-year period. So the first year payment was 20% of the payment. Next year was 40, then 60, then 80, then 100. And then you pay the rest of that. The
20% doesn't start for 2 years.
Right, because it happened in 22. Valuation reports came out in 23. You started paying in 24, 25.
Yeah.
So that ramp continues all the way through, I think, 28, 29.
Makes sense.
And then, as we'll see when I show you your contributions, the good years have a ramp down 20, 40, 60, 80, 100%. So the benefit of this ends out getting spread over a few years before it fully kicks in.
So one of the things, if there's a protracted decline again or sharp decline like that again, one of the things I'm gathering that happens is that, that they can react by offering things like the ramp that you're mentioning.
Yeah, well, they
It's
got the
not-
ramp,
it's-
and
it's-
they
it's
start with the ramp.
liable to a certain degree because they know what practical.
And because they believe over the long term that their assumptions are good and that there's just a lot of volatility, they also understand that because of Prop 13 back in 1979, that agencies have trouble changing their revenues quickly. You know, you're basically locked in. You don't want to go to the voters and ask them for a new tax just for a couple of years just to pay for something because costs went up. They're trying to keep costs as steady as possible for
It gives
agencies.
us and making budgets that are over multiple years.
Yeah.
I don't want to call it predictability, but some level of a band at least you could work in without going, hey, you know, we need an extra $2 million around just because the market goes crazy. We're going to get hit in 2 years.
Right, much easier to do planning.
Got it.
So, yeah, another feature in there. Now, the assumption changes I talked about are first going to kick in with the June 30, 2025 actuarial evaluation report. Again, those reports are going to be released in August of 2026, and those are going to be used to determine value contributions required beginning fiscal year 27, 28. So while we know what these are right now, they're not going to end out hitting your budget for another year or two. The other thing is, you started making additional contributions to the safety plan. You put $3 million into the plan in June of 2025. So that that was significant. And in my modeling, I show the impact of that to help.
Money before that too.
Yeah.
Yeah.
That's in there.
Behind putting it in one versus the other, I'm sure it was obvious, because you had a choice of which plan to put it into.
Right, and
But why didn't, you could put it in either plan.
you could put it in either plan.
But one was more well funded.
Again, I don't remember, I'm not sure,
Okay.
we talked about the logic, but
Why we put it in public safety? Because it was a higher liability.
Yeah, you just feel them combined, you said it was breaking.
right, and I know for a lot of the agencies that I deal with, they also have a bunch of enterprise funds
Mhm.
that end out paying for some of the miscellaneous costs, but not the safety. And so since the enterprise funds are not making these additional contributions, you don't want to give them the benefit of making those contributions. So they end up picking the safety because that's fully paid for by the city. And that way you made the payment, you get the benefit.
Like the winter enterprise funds is like a sewer plant, water treatment plant,
Yeah,
water, electricity,
Utilities.
gas, utilities. Yeah.
it's another personal money.
Well, those are your rates. Those are paid through the rates of the people.
So, and again, just, the more you pay, put into your unfunded liability, the lower your contribution is going to be over time. So you're going to end up saving money. So let's take a look at the impact of all this. So I broke this into a few different pieces here. And it looks like there are 3 lines, but there are actually 4 lines here, and I'll talk about what's here. The orange line at the top is your baseline projection. What that is if the 2024 actual evaluation reports, things happen exactly according to those evaluation reports, those match the investment return, no additional contributions. So that's where we expect the unfunded liability to be. You were slightly over 20 million, and we're expecting you to get down to 100% funded in 2043. Slowly decreasing for the next 15 years and then, finishing off at the end. The blue line shows the impact of your additional $3 million contribution, which shouldn't surprise you, dropped the unfunded liability by 3 million. Now, and got you to a place because the amortization bases that you picked to pay off are expected to get you to 100% funded in 2040. So 2 years earlier. There is a gray line that is hiding underneath the yellow line here. And the difference between the gray line and the yellow line, both of them take into account the 12% investment return that was earned. One of them is based on the old assumptions and one of them is based on the new assumptions. And the fact that you cannot tell the difference between the gray line and the yellow line basically shows that the new assumptions have almost no impact on your funding. They made a bunch of changes that mostly cancel each other out. And in your case, pretty much cancel each other out across time.
Ira,
Yes,
you use the term unfunded actuarial liability.
yes.
I think CalPERS, the term that we've been using is unfunded accrued liability. Is that just, is there no difference between the two?
You could think of them the same way. The reason I'm using unfunded actuarial liability rather than unfunded accrued liability is, in my mind, when I talk about accrued liability, when I talk about actuarial liability, what we have is basically when somebody starts their career, they have no liability. When they hit retirement, you sort of pay all the amount. And we have a path that we are going on to fund them, and this is how much money we expect to have in there. That's the actuarial liability. And that's what CalPERS funds you based on. And that's what they're calling accrued liability. When I think of accrued liability, what I think of is what happens if everybody leaves right now and how much they have. And that's based on final pay right now, not projected final pay. There are a lot of things that are in there. So accrued liability to me is a lower number. It is not the number that's being measured there. It's the wrong term, but it's the term that tends to be used more often.
Okay, I just asked because there wouldn't be a different set of numbers.
No,
if you
and
said
the thing is
accrued
that,
liability. It's
right,
the same
and while you'll see accrued liability in some of the reports, or more often, I think CalPERS is using unfunded actuarial accrued liability. They use both terms. There's how what the term actually means and how it's used. In terms of how it's used, it's the same thing. Just because this is my problem with having been doing this for way too long. It just bothers me when people use the wrong words. So, that is, so that's why when I designed the software for TrueComp, I made sure that's what the term is that we put in there.
This entire chart though, isn't it also dependent on CalPERS's rates of return over those?
Right, we assume after the current year that they're gonna hit their 6.8% target. And again, showing you the software, we can play with those things. And that's the nice thing about the software. We can go, okay, what happens if they do better? And now let's depress ourselves and look at reality and see what we think they're really good.
Why would things go negative though?
They go a little bit negative, partly because there's the time lag between when they do the valuations and when they set and when you pay the contributions. So that ends out putting things a little bit, moving things slightly ahead of 100% funded at certain points in time. And the other thing is before PEPRA kicked in, when you got above 100% funded,
It was at one time, right?
they would lower your contributions below the normal cost and give you a credit to bring you back down to 100. But one of the changes in PEPRA basically said that no matter what your funded percentage is, it could be 110% funded, 120% funded, you still have to pay at least the normal cost. So there's no mechanism right now. And the reason they did that, back in the late 1990s, early 2000s, CalPERS was what they referred to. They created this new term called superfund, because there was enough money in the plan to pay for all the projected benefits for all the employees that were there without any extra money coming in. So cities and towns stopped making contributions. They told their employees to stop making contributions. And there was plenty of money in there. The thing is, when the dot-com bubble burst, they ended out falling short. They also, right before that, happened to raise benefits. The combination caused huge unfunded liabilities to get created. And agencies, and we had an economic downturn with the bubble bursting. So when agencies had less money, that's when CalPERS started asking them for more money. And they've been paying nothing. So putting it in the budget, something, was politically really, really painful, more painful. It tends to be more painful to go from 0 to 100 than it is to go from 1,000 to 1,100 in terms of the payments you're making. Because if you have something in the budget, you make adjustments, even though it's the same increment. Politically, it's a lot more difficult to start putting something in there when you had nothing in there before. So one of the lessons learned, they decided that when they set PEPRA in place, that they're never going to let the contributions go below normal cost. Never is probably not the right term to use. It's not supposed to happen. If we get to a place again where everybody is 170%, 170% funded, I think they'll change the law. But until then, you're making at least a normal cost. So what happens is you end up getting a little bit ahead of schedule, ahead of target, and they keep asking you to put extra money in. It pushes you more and more ahead of target. And that's what's reflected in the yellow line continuing to go down over here. This funded percentage is sort of just the same thing with just the inverse. And again, expected to hit 100% funded right now in 2036. Contributions, blue line is where we're expecting the contributions to be with just the 2024 valuation. With the extra money you put in, you drop down to the yellow line. So the peak, instead of being about $4 million, drops to about 3.75 million. The additional return, bringing it up to 12%, brings the peak back. Instead of the peak being in 2031, 32, the peak is now in 2028, 29, and it's expected to be somewhere around 3.5 million. And I apologize for not noticing that I didn't stick an extra decimal place on the side over there. Contributions, as I mentioned before, contributions are a combination of normal costs plus payments towards unfunded liability. So if I show you a graph of how those two are broken down, the orange here is the normal cost, the payment for each year of service as it's earned. And you'll notice in that those bars tend to stay about the same size for the next decade. And the reason for that is while they do go up with payroll, they're coming down because your population is expected to shift from mostly classic members to more of the PEPRA members, from the higher benefit to the lower benefit, and those two mostly cancel each other out across the next decade. The purple are your payments towards unfunded liability. You'll notice that right now, 60% of your payment is payment towards unfunded liability. It's going to increase to about 70% over the next few years. And you can see a little bit of the step up that's still built in there. We have the step up, and we have the last couple of years, a little bit of a step down coming in. But there was you can see the step up in the purple. So most of your payments are due towards payments towards unfunded liability. And to the extent that you end up paying off more of the unfunded liability, that is going to help you across time, lower your costs, bring down the contributions. So the question is, why do you pay off your unfunded liability? Well, again, most of it's due to unfunded liability. Unfunded liability is basically a loan from CalPERS, and it's an expensive loan. They're charging you 6.8%. It's an assumed rate of return. So as I said before, more money paying off your unfunded liability, lower unfunded liability means lower costs. And I've already talked through where the unfunded liability comes from across time, how it's amortized. So you've got pages here, and this goes through that 20, 40, 60, 80, 100% phase in, ramp up, ramp down that we talked about before, because you people asked questions and didn't patiently wait for me to get to my point.
You told us to.
I know.
If we give them $1 million, they don't charge us 6.8%. They don't charge us $680,000. And now we have $1 million with them. Is that that's not necessarily part of our return, that's just the reduction of our unfunded liability.
Well, yeah, but you get the return, so effectively it does both.
I'm just wondering, if I look at $1 million sitting in the town and I look at $1 million liability, if the movement of it over there, how's that math work out? I save 6.0 over here, but I lose, whatever our bond for it.
Which is probably about 3 right now. Yeah. Yes, but, and it's a very important but. Okay. CalPERS will take your $1 million or your $3 million that you gave them and put it into the plan. And the thing is, you gave it to them last year and the markets did relatively well since then. So they immediately pay off 3 million of your unfunded liability base. They lower your unfunded liability payment. They put it in your assets and they invest it. So it was doing relatively well, and it, it had earned 10%. So you got 10% credit on it through February. But as the markets drop,
that works. That $3 million, if I could isolate it and set it aside, I would actually see that in their portfolio and earning 10% through this thing. So
you made 10%. On the other hand, as when the market drops,
$3 million,
you can lose money also.
When we put it in the 5 million.
Yeah.
When we put in the 5 million in 22, that's when it was a negative.
That's when the markets went down. So what happens is, and so one of the discussions that I've had with dozens of agencies is they had extra money set aside. The question is, should they be putting it in CalPERS or finding some other way to sort of get to there? And because of the volatility in the markets and the uncertainty in the markets right now, I'm not personally as big a fan of putting huge amounts. Additional amount contributions are good things. Huge additional contributions basically have a lot of risk that the market goes down and you give them 10 million and they lose 10% the next day. So it costs you 10 million and they only get 9 million of benefit across time. Some agencies are, again, incrementally sort of almost like dollar cost averaging, putting their money in. If you wanted to get it out of the general fund because I don't know, the town won Powerball, you've got all this extra money sitting around. You want to figure out what to do with it. A lot of agencies have set up sort of a special type of pension rainy day fund, a Section 115 trust. And those tend to be invested in a way that gets you more than the 3% the internal assets are getting, but not as good as CalPERS with less volatility. So you'll get 4%, maybe 4.5% right now with not that much volatility. And so if the markets drop, there's still the money in there. You don't lose much, but over time you're getting better returns. And then you decide when you move the money from the 115 trust to CalPERS. So when you have the money, you stick it there, you put it in hold for a little while, and then when you think it's the right time, you start making movements over to CalPERS. So that's some of the things that some agencies are doing across the country.
Then you're saying, I'm going to predict when the market is going to go up or go down.
What you're doing is you're saying that you're putting some of you're rather than taking a chance that you're expecting big swings in the market, and there is a lot of unpredictability that's going on, or a lot of volatility that's going on in the markets right now. So putting it someplace a little more conservative, getting a slightly better return than your internal reserves is good. And then the whole concept of dollar cost averaging is not to get hit by big downsides. So you're giving up some of the market were to shoot through the roof, you might miss a little bit of that, but over time you're going to be okay at moving it that way. It's I don't think I'm not a big fan of telling small agencies, and compared to CalPERS, we're all small agencies, that they're going to have better expertise than what CalPERS has. But CalPERS is going to be continuing to just look at the long term and aggressively investing their money. And they're okay with 1 year losing 7%, the next year making 15. Local agencies may be happier with a little more consistency in their returns. So that's why a lot of agencies will go into the 115 trust. It's not necessarily for everyone, but it's been used by a lot of agencies being concerned about, that at some point a market correction is going to be happening, and we may be in the middle of one right now. That they'd rather not hand a huge amount of money to CalPERS when that's going on.
So the town has $3 million and it doesn't have a better use for that money. It was just going to sit there over time. Does this finally just come down to how does our investment pool do against your investment, against CalPERS investment pool?
Well, again, you've got, so in my mind, you have three options. You have your investment pool, which is required by law to be
Yeah.
short-term, high quality, low risk,
Yeah,
governments. So you're gonna earn your 2.5% to 3% all the time, no matter what's going on. You can go with CalPERS, which is the other end of this thing, which is going to put their money into, 1/3 of it in private equity and private debt. Over the long term, they're gonna make some good money on this thing, but they're gonna lose some money in certain years. And they should average 6.8% or even 7% if you're believing what their investment consultants are saying, which is over the long term, a better return. There's the in-between, which is the Section 115 trusts. And there,
I get the 115. I'm just trying to figure out next time that we revisit.
Right, but
we
you
got an
can
extra
take that
$1 million. How do I simplify this in my mind? And the way I simplify it in my mind is I say, there's $1 million. I imagine the town could figure out some way to use that. But if they didn't find a way to use it and it was an overage, then for me, it's like, well, what's our bond portfolio do? It's 3%.
right,
What's the opportunity that CalPERS is gonna do it? Well, maybe they'll be down, but maybe they'll be up over time. They'll do
over
well.
time,
Is
they'll do
how
that.
the
And,
decision
and
finally
over the
comes
next,
down?
over the short term, over the next
Yeah.
2 to 3 years, you're paying off an amortization base where they're charging you 6.8%. So if you have a
the
choice,
certainty of that, because that amortization is gonna come in anyway. So you're just advanced paying on.
you're advance paying it and saving the 6.8%.
So that's an additional plus because we're
Yeah.
not earning 6.8 on it.
Right.
So it's pretty obvious. You've got it fixed for 3 million.
So, right, if you have, if you got enough reserves built here and you have 3 million left over on top of that,
Yeah.
then paying off the unfunded liability is, whether you do it directly or in steps through the 115 trust, is a good move.
Yeah, the only black box is the investment.
Yeah.
Well, like on the OPEB is in a 115 trust, and we started out with a baseline of 5 million, and now we're about 9.4 million, and that's over time has been about average like 6%, 6.2,
Yeah,
6.5%.
right, the OPEB trusts tend to be not as aggressively invested as CalPERS is.
But building
It's a way
money,
not to give it to them, but not be restricted to 3.5, but to a bond portfolio.
Mhm.
Yeah.
That's another pool.
Yes.
It's legal.
It's a legal pool and it does give more flexibility to you because you decide when to move it from, unlike when you give extra money to CalPERS, they reset your contribution rate and then it becomes fixed and you can't say, I gave you an extra 3 million, can I pay 2 million less this year? That's not okay. So once you do it, they reset the rates and they put new required payment stream in place.
It's more of a do-it-yourself part. I want to invest this money.
So, yeah, but again, most of the pension 115 trusts tend to be relatively conservatively invested because you're only planning on keeping it there for 5 to 10 years before you end up moving into CalPERS, depending on how you think volatility is going to be or what you're worried about in terms of, you're worried that, something may happen and you may have to replace, the sewers or something else that may cause you to, make a huge payment that you didn't necessarily reserve someplace else. So you can make your regular payments from there and then use that extra money you would have made to the general fund from the general fund and use that for some other purpose.
So with the trust, we can use that money.
Any money that goes to the trust has to go to pension. But you can decide whether it's regular pension or additional pension payment. And you can decide when you give it to CalPERS. So a lot of agencies start off saying, what I want to do is sort of cut off the peak that's above $2.5 million here. So I'm going to set some money aside because I have it now, and then I'll pay 2.5 million for the general fund, and anything on top of 2.5 million is going to come from the 115 trust. That way my budgeting is a whole lot more consistent, and I've got the money sitting out there. And that may be their original plan. But then what ends up happening is you need a new fire truck or the sewers end up having a problem. And you say, okay, fine, I have enough money in there. I'm going to make the full $2.5 million payment this year out of the 115 trust. And I'm going to use that extra money to deal with the other problem that's on the side over here. Because you have the flexibility. It's a reserve, it's a rainy day fund. But again, it has to go towards the pension fund.
Has to go, once you put it in there, it has to.
There's only one place it can go, but
Fire
yeah,
truck.
right. But if you spend 2 million there, you have 2 million left,
Frees
and
up
you
in
do it for your
the
regular
operation.
payment, then you had 2 million you would have used in the general fund that you can use for something else. And then what the other agencies end out saying, oh, I was planning on doing that, but we have extra money in the budget this year and we can afford it. So they let it ride, and then they find out that they have enough money set aside in 2033 to pay off the whole unfunded liability. And then they pay off the rest of the unfunded liability at that point and get it paid off 3 years early. So there are different uses that you can do with it. And if you have money in there, you've got the flexibility to deal with it. So, and that, again, that's why a lot of agencies go towards the 115 trusts. Others just say, look, I don't need the extra hassle of trying to have somebody make decisions about how we're investing and remember what's going on. Let's just CalPERS is their job. They do this. They've got the best people to make these decisions, and we'll give them the money. So, this is not, I'm not sitting here saying it's the only way to do things. People are not doing the right thing. You're doing a lot of good things right now.
We have the 115 set up for pension, don't we? We just don't have any money in it.
Yeah, we don't have any money.
So let me just rephrase what I thought I understood. If you have this 115 in some given year, say you've got $1 million in it, you could use the $1 million to pay your required minimum UAL payment.
Absolutely, if that's what you want to do.
So that it is like you're retaining the total flexibility of essentially like kind of clawing back.
You're retaining a lot of flexibility. Now, if you have $1 million and your contributions 2.5 million, yeah, you got the full flexibility. If you have 10 million in there, you can only have 2.5 million in required contribution. So you can only really save you 2.5 million of the budget.
Yeah.
I mean, you can move the whole 10 over, but only 2.5 is required. So you only save your general fund 2.5 million. So it's not full flexibility, but it's a lot of flexibility.
Kind of like what we're doing with OPEX, right? We're not paying the expense for the retiree health, which is about
Yeah, that's good.
500,000.
It's fully funded.
Right. But we freed up 500,000 in operation budget because of it.
Yes.
Yeah, it is.
Yeah.
We're gonna have money left.
Just,
over.
I don't know why, although, unless the town was really in dire straits, it probably wouldn't be a very prudent decision to essentially forego making a UAL payment just because you've got these funds that you can make it. That's like taking funds that you already set aside in the past
Right,
and using it this year.
right. It's something had to really go wrong.
Yeah.
Yeah.
And sometimes something that goes wrong is it was bad planning, and sometimes it's just bad luck or outside forces in the economy, and all the real estate values in Atherton get cut in half. And everybody, so.
One of the things that we've discussed here is we're currently making an $861,000 a year payment on our COP for the town center, which goes away in a couple of years.
2030.
2030. We could continue to make that payment into the 115 fund instead at that point in time, because it's already factored in our budget.
Yeah, convenient.
And just,
It fits the boxes in your head.
But you'd still probably never touch that unless a time came when you were running out of money, essentially.
or wanted to make a
Huge
huge
payment.
contribution to California.
Right, or the market just
Yeah,
dropped so
right.
much that your contributions shot through the roof when you didn't have extra money to spend.
But you're still, but if that's kind of the way you think it's gonna happen, then you're saying you're trading an expectation of a long-term rate of return of 6.8% for an expectation of 4%, something like that.
Well, yeah, and again, to me, the one of the biggest values, especially if, and I tend to be a pessimist when it comes to, markets. I think that when I put money in, they all drop. And as soon as I take my money out, everything goes up. Kind of just proof that God exists and he hates me. But
No,
so, I mean, if we end out having another year like 2022, where we end up having this big hit and your contributions are going to be going up. Or if we have something similar to 2008, where the economy ends up getting hit. So what's going to happen is the markets plummet. At the same time, the economy goes down, so your revenues shrink a little bit. Your costs go up a lot. That's a nice time to have a rainy day fund, something there. So what you do is you're protecting yourself, because then you can say, okay, that extra amount, that 20, 40, 60, 80, 100% ramp that is coming in and making me make higher payments when I have less, that's the time to take this rainy day fund and use it. If that never happens, then fine, then I keep holding it in there and I end up paying off the unfunded liability a few years earlier, and I end up saving money that way.
It's a question of whether the town just wants to be continue to be a net saver or not.
Yeah.
Right, and now we start overgeneralizing.
It is,
Are
this
we,
is.
are we a net spender or are we a net saver?
Yeah, and again, this was not one of the issues that I was planning on saying, decide now. This is a one-time opportunity. It's like I'm selling timeshares. You have to buy it now. Think about this over time. You have different time, you know, when you feel like, oh, you're looking at the budget, you're doing other things, you have, oh, this extra money, you just don't know what to do with. And nobody wants anything from anybody. Then you go,
We
okay,
don't have that.
yeah.
We don't have that, but it takes us a
Yeah.
while to get projects done.
Yeah.
Because we have a small staff,
Mhm.
but we have lots of key things we have to get done.
Mhm.
And there is a consideration that the current council has paid for a lot of sins that past councils
Mhm.
just let go.
Mhm.
Okay, and part of the question is, when do we stop and let other people pick up some of the burden?
Mhm.
Yeah.
And so that's some of the things that I think about. I think we did a great job with the OPEB. I think we did the right thing making the investments. And maybe we need to do this rainy day fund. I can see that to a certain extent, but I can't see it just continuing every year, put money in there, because like I said, we have needs today. And I see a lot of this now as paying for what previous councils just willy-nilly just went on, okay? They didn't save any money, they just talked about building a new building. We did it, and they knew we had to do certain things with regards to drainage and street repair. They didn't do that either, okay? So, part of the discussion that we will have to have is, our current needs and the satisfaction of our residents. Are they, getting everything that, and the enjoyment that they expect to get for their property taxes? As well as, so I think there's a value to the rainy day fund to a certain extent, but not something that we put in every year. We've done the 5 million, that was kind of a bad timing, and then we did the 3 million. We did the OPEB, so we have done a fair amount, but I don't know that we need to do a substantial amount more personally, because, if we're supposed to be complete based on where we are in less than 8 years,
It's hard to say when you don't have a particular spend in mind. So if the town has got a reserve and it's more than adequate, the idea that you're gonna save money for some unknown, you go, well, that's the reserve. I mean, why are we gonna do with this? It's very difficult because it's so attractive.
Yeah.
It just keeps talking to you and saying, what are you gonna do with me? And people have different points of view.
Yeah, and we have concerns about, we built this new library, we modernized the old council chambers and built the new building, but there's gonna be maintenance issues and things like that that are gonna come up and cause additional costs
Mhm.
in the future. We need to consider that before we say, hey, let's pay off everything before the next 8 years, so that, when a new council comes in, they say, hey, we just got all this money. You
Yeah.
know, we don't have to pay that.
That's why your multi-year budget needs to be accurate, not brought up or brought down by soft numbers.
So anyway,
Anyway, it was a great presentation.
this is the presentation. Then let's go to. I have the software. So the extent that you want to run what if scenarios, this is what the software looks like. We put in your data, your assets, your benefit structures. We match up, we basically have underlying this is a basically powerful calculation engine matching what CalPERS does. So we get within 1% of their costs and liabilities at any point in time. And we can show where your costs are going at different points in time. Right now I've got it set up with the 2024 baseline, but actually, now I'm doing this. I should probably have my glasses on so I know what I'm doing. So let's switch this to just, I already created the scenario with the additional contribution of the 12% investment return. Let's put it there. I'm going to use that as the baseline. We'll just play with that one. If you want to see, basically start with the dashboard here, which is the 4 metrics that most agencies focus on when they worry about their pension plan. So you have unfunded liability, your funded percentage, the contributions for the upcoming year in dollars, and that's a percentage of pay. If you want to see any more about them, like unfunded liability, go to the circle, click on it. We end up having a graph that shows how the unfunded liability is created, which is a combination of the line at the top is the actuarial liability, even though the words say accrued liability, which I'm just noticing right now, and I'm not happy about. The blue are the assets, and the gap in between is red. Each of these graphs is you can sort of play with them a little bit because it's designed to be basically a communication tool. So if I get rid of the certain things and only focus on unfunded liability, you can see the unfunded liability projected over the next few years. The way it projects.
So you input only, or is this the town actually goes and
He has access and staff has access to it. And it's,
They update it for us.
we update it
No.
because we don't expect you all to have actuarial certifications, and we have staff that does all that, and we get the data from CalPERS.
So can you do a multi-year thing, as I say?
So I can go as many as let's go 25 years in the future.
Mhm.
So what it's doing when I do that, what I did is I changed the number of years projected up here. And each year, it starts with this year, and each year it projects forward. In the baseline, which is what we have right here, I have, it's not quite the baseline because I did assume you have the additional $3 million contributions coming in this next year. So you'll notice the big drop in the unfunded liability between 2024 and 2025. That's because you put the $3 million in, you get the 12% actuarial return or investment return. So you see the unfunded liability come down. After this, it starts out assuming as the default that it's going to earn the 6.8% return, that all future, that your people are going to leave on when they're supposed to, that when someone's supposed to retire, they retire. When someone's supposed to become disabled, somebody disables them. When it's their time to die, somebody makes them disappear so they no longer get any money. All of that's built into what's going on here. But we can, and I'm now setting it up so it projects out for 25 years instead of for just 5, moving all the way out. And you'll notice after 2037 goes away and turns green. Green, it basically says you've got ahead of targets over 100% funded at that point in time. The reason, again, as we talked about before, is because you have to keep making normal cost contributions once you get ahead and the time lag does
So
that.
that's assuming it's $3 million.
The
additional
one time
this
$3
year.
million. Yeah. And assuming 6.8% return. So let's take this year's return and we can say, all right now they're 10% up. So what happens if they earn 10% for this year? Put 10% in there, rerun the scenario again. It's going to recalculate all this. And I can get rid of it. And you can see what happens. You can see what was the baseline before and the new one. And in fact, if I just show the unfunded liability, comparing one to the other, the green is the new one. And you can see how it basically builds in And in, just a few seconds, we've shown what's going on here. Now, if instead, and I can name this, so I can call it,
What we paying for the debt service?
sorry, let's
How
name
much is
this.
the debt service
For this,
for
for
the
this,
COP?
oh, 861, 861,000.
And how much are we paying the county back for?
Okay, so I gave it a name, 10% return in 2026, so that we know which one that is. But what we could also do is say, okay,
$6 million a year.
let's say the market crash continues to keep dropping. And over the next few weeks, things go really bad, and we end up with a minus 10% for the year. It'll then recalculate this, what happens with a minus 10%. You see, if they end up losing 10%, instead of making 10%, unfunded liability is going to spike back up to 25 billion, and then slowly end up getting paid off as it goes across time. And if we look at contributions,
One question, is this blended across all 4 of our plans?
this is all the plans together. Now, all the assets happen to be together. So as I'm talking about the assets, this all works all together. We do have filters in here that you can break out to any of the plans separately. Through last year, your costs were calculated and shown separately for classic versus Petra, miscellaneous versus safety.
Now they've combined.
What they did this last year is they combined all the miscellaneous plans are now in one big report. All the safety plans are in one big report. They combined your unfunded liability for all of those. So we've set this up to match that, filter out the just miscellaneous or just safety if you want.
How about just a scenario where it's $1 million a year?
Additional money?
Yeah, for the next,
Okay,
6 years.
Let me get rid of these scenarios for a second because I don't want to clutter the screen too much. If I go to additional contributions, sorry, wrong place. Let's make this easy. I'm gonna assume the extra money is going into safety
right?
because you like them better. And we're gonna assume, why is this? Oh, because I put someplace else. Starting in 25, 26, let's take $1 million a year for the next 3 years, next 5 years.
5 years, just for 5.
Okay, let me show 10 years of input. So 1, 2, 3, 4, 5 years of additional contributions. And then I run this scenario. Now we take a look, let's show the comparison of unfunded liability. What you see, and you can see that unfunded liability is coming down a little bit faster over the next few years. You're going to end up about $5 million less right here. Actually, yeah, not quite $5 million less. And the reason it's not quite $5 million less is because when you make extra contributions, when you pay off some of the unfunded liability, future contributions end up coming down. So your future contributions ended up going down. In fact, if we want to see how much, go to the contribution screen, and you can see how much the contributions are coming down on this one. By making those payments, the required contributions drop from what was supposed to be 2.8 million down to 1.8 million. So you're saving about $1 million a year. By making those 5 payments, you're saving $1 million a year moving forward for the rest of the period for the unfunded liability. So you're making your money back basically plus the 6.8%.
Right. Okay.
This is sequence of return risk, the idea
That's what we
that
should do.
right now, on out, today, we're gonna have a 10% decline. We're gonna suffer from that now on out.
Well, we can do just 1 year, or we can do multiple years. I mean, if you really
It's
want.
the idea that I'm gonna retire, I need the same amount of money that I need every single year. In the first year, I need $100,000, and the market goes down 10%, but I'm still taking $100,000. I'm kicking the damn can, and it's down in value.
Right,
Is that what this is modeling?
Well, I mean,
It's a bad year to begin.
it would model that if that's what you're putting in as the model. And in fact, what we saw in 2008, when the markets really plummeted, they lost 24% in 2008. Some of the agencies went into that time period about 80% funded. They lost all that money. They dropped down to about 50% funded. They were still making full payments out of there, but the returns, they have lower assets, and the returns weren't going to be weren't doing as much work because the assets kept dropping down because you're basically continuing to make big payments with smaller and smaller assets. And the contribution requirement gets corrected to shoot through the roof to catch up for all of that. And that all gets modeled here.
That description that you had before, when you said, how do you come up with the value? How do you kind of cheats come up with the value of the overall fund? When you said the money in equals the money out, kind of, that's what money in does not equal.
Well, but the thing is, again, if future experience, and we can put in future experience like this, if future experience, this model lets you say, what if future experience is different than what was expected? What's going to happen?
I get it.
And if you are trying to figure out, do I have enough of a cushion? Am I worried about it? Can I, if the markets go bad, can we afford, how much of a hit is going to cause in our contributions?
Yeah.
This is nice to know.
What's a reasonable approach for that? So Robert's gonna sit down and he's gonna go, you know what? And I'm doing a 5-year budget, I'm doing a 10-year budget. I need to come with some idea of what, not disaster necessarily that could happen, but what does an actuary start to play with, other than saying, well, this year's not gonna be 10%, it's gonna be 7%. How do you, so you can get a parameter?
I tend to recommend, I recommend stress testing. So basically,
That's what I'm getting at, and the
Yeah.
budget should be stress test. You should have another
Right.
one that
so
says stress.
having in place what happens and do a few scenarios. There's if I'm doing this with finance PhDs who love all the market stuff, then I'm going to do 10,000 stochastic different analysis and try and show the variation of all that, and they can look at those and see what's going on. For most people, what I recommend instead is pick a couple scenarios that are good news and bad news, and try and see what's going to happen there. And
then also think that,
can you live with
they're
that?
going to be reactive, right? If we're going to have one of these great down periods, is that they
Right.
come back with a ramp where we don't
Right.
have.
So you look at what happens with the down period. You say, okay, am I prepared to handle it? And if the answer is yes, you feel pretty good about it and move on to something else. If the answer is no, then it's like, okay, I should probably get more, put more supplies away, build a bigger rainy day fund, do something to make sure that you're in a better shape if something bad happens.
It's the same thing for our source of income.
Yeah.
Changed.
Yeah. So this is a tool and lets you do it in seconds. And again, your staff has access to this, but the reality is that I don't know how often Robert actually goes in and uses it. If he is at the median of where our clients are, he'll look at it once a year. What we tend to have.
Talking about a rainy day fund and the idea that we don't have something to spend it on. My thought, and maybe this is part of that deal. It's like, hey, you don't know. I don't think we need to say the end's coming near, but
Right.
at the same time, you could say,
but look, if this happens, we want to be prepared. We don't want to have.
yeah, how far can it go?
Yeah.
Without going to.
Right. Not going crazy, not going, okay, but if we say, okay, what happens if 2000 happens again? What happens if 2008 happens again? Could we handle that? And if the answer is no, then think about how much of that you could afford to sort of protect yourself against, even though it's not likely. If the answer is yes, then feel good about yourself and go, okay, we're in good shape. We can, do whatever else we need to do. We're not passing this on to future city councils.
You do have to remember there's a lie too, Steve, that even if this year is a disaster, there'll be no change in what the town has to spend for 2 years, and then there's this 20%.
Yeah, that's the way I think, though. I think of 10 years, just think out. So, because a couple of years ago was today's, you know what I mean?
Well, that's true.
You planned on it, and here's where we are, and it's a great place to be. That's right.
So this becomes a tool. Again, it's relatively easy to use, and usually what happens is Robert will call us and we'll sit down over the phone and go through scenarios.
Yeah.
And you certainly could use it when you're in it.
Yeah.
Market decline, hear enough news, you can fire this thing up and say, hey, it's gonna be a market decline.
Right. And
Spit out your numbers for the next 5
in
years.
2020, I was getting a lot of phone calls when the world was ending
Yeah.
of what's gonna happen. Show us how bad this is gonna be.
That's, the data's already in there.
Yeah,
The
That's
OPEB
good.
version of this has employee census data in it. Does this have employee census?
yeah,
data?
this has your people. We basically, we have, Robert goes to CalPERS, grabs 5 reports off the CalPERS website, sends them to us, and we get your people with your benefit structures and match all this up.
That's one of the reasons we can't have this on the website and let people play with it and members of the public.
Well, we don't have any personal identifying information.
That's good.
Okay, good. Yeah.
That's good.
This is, no, yeah.
So the OPEB one does, but.
Yeah, this one doesn't. Well, our software calculation, our cost calculation doesn't, but the underlying stuff that we got from you did. And then we erase it because we don't want that. We don't want that liability. We don't want that problem.
Correct.
Nobody's broken into our database yet, but that's a yet. And so we made sure that if they did, it wasn't gonna be, they're not gonna cause problems to all of them.
With the OPEB one, there was concern if we just used it with members of a committee, for example, this was years ago, that they would look at that data and say, okay, we have an employee who's 54. Let's see if we can move that employee out of the organization, making investment decisions based on moving staff in particular directions, and that just wasn't.
Yeah, which is, it sounds evil. On the other
That's a
hand,
good idea, Joe.
I mean, when I first started doing this type of work, and I would get the data from, like, one of my first clients was Coca-Cola. And we would have all the data for all people, and I had my contact. It's like, I went in and I looked and I said, oh, when's this person's birthday?
Yeah.
I'm gonna wish him a happy birthday. And they're like, how do you know my birthday?
I know you're self-secure.
Right? And it's like, oh, okay, I thought I was being nice, but clearly,
So how long have we had this?
We've had this for
Couple,
10 years now.
Yeah,
Yeah, this
Good
is
amount,
this
but
has
it's been
a
up-
great presentation.
but it's been looking,
Totally.
This one,
it's
the
been
best one we've
revamped.
had.
right,
Yeah.
we redesigned this thing from the time when I first started.
they've added more features. I mean, they've innovated it.
And
So,
and we are, and I've been, the thing is, like, it's, we redesigned it about 7 years ago. Partly because our founders had created the prototype that we sold before, and our founders were amazing salespeople and not very good actuaries or programmers. And so they like to make promises that had nothing to do with our software. And then they're saying, do this. And I'm going, our software doesn't do that. So I basically redesigned the software so to give it a slightly cleaner look and did the things that our salespeople have been promising we were going to be doing.
Yeah.
And AI is gonna change.
And the thing is,
Your AI interface.
right now, we are
That's
putting
gonna
an
make
AI
this crazy.
interface on this thing, and I don't know when it's gonna be put in there, but so a number of and what I hope at the very least is not that I want my job taken away, but actually I work part-time and I'm happy to deal with whatever. But someone like Robert should be able to just sort of ask it questions like,
Yes.
where's the market so far this year?
Yeah.
What would happen if the market ends up dropping 5%, and it'll run itself through all of those things?
Yeah, the town contracted with GovInvest back in 2016.
Yes,
Ed
it was
Price was
GovInvest.
the one who made
That
that
price, yeah.
Yeah.
presentation.
Yeah, now it's true comp. And so, you all met Roger, his counterpart with
On the
OPEB.
OPEB side,
On the
yeah.
OPEB side.
Mm.
His true comp does our OPEB, actuarial, so they both,
Mhm.
help us with our pension, help us with our OPEB liabilities as well, so. Yeah, I mean, it's the innovation of it, it's a lot better than, I mean, the different scenarios, the different amounts, it's changed that we can do with it.
How is this better? How is yours better than the CalPERS tool?
It's mine. Of course it's better.
Usability.
Aren't these colors
I think the
nice?
colors and the graphics, it's what makes it better.
Part of it is that, and 5 years ago, had a lot of things that CalPERS Outlook didn't have, and each year CalPERS Outlook has been adding things, which is one of the reasons why we need to start adding the AI interface and other things. But it does a better job of adding a 115 trust in. So for agencies without a 115 trust, not as big a deal. when agencies were looking at pension obligation bonds, potentially doing that, we had features that allowed some of those things going on. It allows you to, again, you can do all the stuff you do in Outlook. So you can pick every single amortization base and decide which amortization base you're paying off. You can play with the timing of contributions. So say, whether you're going to make the contributions in, July 2nd, the beginning of each fiscal year, or you're going to be making them June 29th, or sometime in between, and take into account exactly how CalPERS values all that. It also lets you put in different projected salary, across the board salary increases by, different department or bargaining group. CalPERS just does it across the board. So we have a few features that are still ahead of where CalPERS is. And again, we're going to have the AI stuff coming relatively soon, and we'll see if I can get them to do a couple other features. But it's hard because right now our salespeople are mostly pushing our labor costing and compensation benchmarking tools, the stuff more on the HR side than the finance. So, and because they don't understand the pension, they don't sell the pension. And so more of our stuff is going on to that side. We're still doing some of this because most of our business is still on the pension side in California. So we will be continuing to upgrade this. I just need to make the head of development feel guilty, and I'm good at that. So
I like that.
Thank you.
Yeah.
No, yeah, thank you. I've been working on this for a while, to get, the presentation here, to get him here. It's just coordinating stuff, but, yeah, I think it was a good segue because we've been discussing CalPERS, regularly, and then to see where it looks based off of our 3 million contribution, captures it, and then, we can do some, forecasting with it. So we'll try to bring Ira here once a year so he can say, hey, this is what's going on. This is what I think.
So yeah, happy to do it. I'm just on the other side of the bay, so it's easy for me to get here.
So you can't replace that with AI and a tool. You being here.
Yeah.
And
And the
interpreting
experience.
Information and bringing it to
Yeah,
us.
I mean, as I said, I'm not worried about robots stealing my job. I'm not too worried about that. Yeah, robots may steal my kids' jobs, and then I can laugh at them. But
Yeah, but no, Ira, and then, like he mentioned, he worked in actuary for over
way
30
too
years.
long.
Yeah.
And just one other thing that I do want to say, just because I can now. I'm telling everybody I'm going to be a grandfather. So
Congratulations.
my quiet period where I wasn't allowed to tell anybody ended yesterday. My son and daughter-in-law told me I'm allowed to tell people, and I'm telling everybody.
Awesome. Congratulations.
So, September 1st, I will have a granddaughter. My son and his wife live next town over, and they just moved down to Texas. So I'm hoping Texas ends out having real problems. They move back. But I'm very excited. And
Well, that's awesome. Congratulations.
Yeah.
Oh, man. So now we have to coordinate.
what?
We're in Texas, so
They moved to Austin.
Austin, that's very crowded.
It's the area was too cold for my daughter-in-law.
Yeah.
And they wanted to go someplace that had no state sales, no state income tax, and they needed a place that was vegan friendly.
Okay.
So the only place in Texas that's vegan friendly is Austin.
Yeah.
That's where most Californians go anyways, is Austin.
Well, yeah, that's what all.
Yeah.
So, and yeah, and we've got other family out there, which my son did not even think about when he moved out there.
No.
But, so I am,
Well, congratulations. That's awesome.
yeah. My brothers said that makes me 20 years older immediately.
Yeah, it does. It does. Now his schedule is gonna get filled. So now we have to coordinate off the granddaughter, the time I was. So I can't do it this meeting. I'm babysitting. No, but thank you. I really appreciate it.
Yeah, thank you very much. This
Yeah.
is great.
Yeah, really great. and safe travels to, oh, to Cleveland tomorrow.
I'll be Cleveland.
They thought out. So.
Yeah, I'm being punished.
Yeah, definitely. Oh,
Great.
yeah. Also, the next item is our presentation review and acceptance of our fiscal year 24-25 audited financials. We have our senior partner auditor, Grace Zhang is here, and thank you, Grace, for being online and being on this presentation. Our pensions, so you can see that we're doing everything we can to manage our costs. But real quick, just wanted to present to the committee, within your staff, the financials, you have the staff report before you, kind of did a high level of what is in the basic financials. So over real quick, 26.3 million in revenues to 23.2 million in expenses. We have the transfers out, 2.6 million. So we have a negative excess deficit of revenues over expenditures of 577,000. We have a healthy fund balance, but without stealing Grace's thunder, just wanted to turn it over to Grace. He's here to answer your questions, but I provided you with the MOIC memorandum of internal controls with you. There's just one item, and that was on page 9 of it. And then I updated the page 2 opinion. But just want to turn it over to Grace. Welcome, Grace. Thanks for joining us.
Hi, good afternoon, Robert. Good afternoon, committee members. Thanks for having me here today. My name is Grace Zhang. I'm representing Mays and Associates, and I do see some new faces here, so just want to give a brief introduction of my company. We are an independent external auditor of the town, and we are one of the most well-known regional municipal auditors. And I have been with Mays and be a partner for over 20 years now. So we have completed the financial audit for the town 2025. And as you can see, we have an unmodified opinion, which means a clean opinion of the financial reports. Together with that, we also issue the required communication and memorandum on internal control. Just have an overview of whatever, if there's any findings, if there's any important things regarding the financial reporting that we would like the readers to be aware of. They are all communicated via the formal documents. And we are happy to report there's no material witness or significant deficiency type of findings for fiscal year 2025. That's my brief summary of the audit result, and I'm here to answer any questions you might have.
Was there a management letter that was issued out of this for things that you were concerned about?
Yes, it's summary in the memorandum on internal
Yeah,
control.
memorandum of internal control. It's the very back of your financial statements at the end. Yeah, and it's page 9 of it. Everything was fine. There was only one prior item on it, and it's on page 9 of the memorandum of internal control. It had to deal with the timeliness of the treasurer's report in ensuring that it gets sent in 45 days after the end of each quarter. So, for instance, the end of this quarter, March 31st, will be the end of the third quarter for the fiscal year 25-26, ensuring that 45 days from March 31st that the treasury reports get submitted. So that's what their report was, that is just the timeliness of ensuring that the treasury report gets sent to the council. There's times too also that the timing of a council meeting and the timing of when the financial reports for the investment statements are available. So we could take it to the following month of a council meeting For example, also where the council has no council meetings in the month of August. So the ending quarter of June, if it doesn't make it in July, will council meeting, it would obviously be on the September council meeting. So we take those into consideration. It was just that was their finding within this audit, was just ensuring that they get turns in presented timely within the 45-day reporting window.
Lisa, I had a question about the governmental funds balance sheet and
Yes.
how the fund balance is broken down at the end between non-spendable, committed, assigned, unassigned. I know there's a note that describes in general terms what those are, but could you add any detail to, like, what is the $3.5 million of the balance that's committed?
Yeah, good question. The details was break down in the footnote number,
For number 6. Yeah,
yes.
but number 6, I think page 50. Sorry. I think it's 62.
61, I've got
62, footnote 6. 62, page 61 kind of describes the fund balance categories between non-spendables, restricted, committed, assigned and unassigned, and then 62 shows how it's broken out.
what is this committed for emergency disaster?
Oh, that's our 15% set aside. The city council has a policy of 15% set aside, must be set aside for emergencies. So that 15%, that 3.4 million is 15% of the actual expenditures. And the actual expenditures for the general fund was 26.3 million.
That's 15% of
The revenue.
Of the expenditures.
expenditures. What about the other 15%?
The other 15% is in the unassigned balance. It's in that 8.2 million. So if we back out the 3.4 out of the 8.2 million, that'll give us what the other 15% is.
We have an emergency reserve of 15% and an
Yeah.
operational reserve
Of 15%, but that's in the operation reserve of 15% is in that unassigned balance. It's just a way to make sure that we meet the requirement of the 15% operation reserves, but the way we classify it is it's within the unassigned balance.
The numbers used to be higher, by the way.
Yeah, they used to be 20%, right?
It used to be 20%, but we brought those down a couple of years ago.
Yeah.
So, but like, why is, one part unassigned and the other part is committed?
Well, the one that's committed, that's part of a policy that's to identify that. But the unassigned, because it's basically, that's the operation component. It's still based on operations, making sure that we still meet that 15% within operations, meaning it's unassigned, but it's basically I guess a category of making sure that we meet our operations component.
But is the emergency part something that we have designated as an emergency, or is that like a legal requirement that we have to maintain?
Usually, before I would touch the emergency fund, we would want to declare a local emergency such as COVID or some other sort of situation before I try and ask the council to use those funds. I can't touch either of those funds without council authority. The operational budget, though, that one's more just, overtime, police overtime. There's a big issue this year or something like that I could ask them to use that one before.
Yeah, and in the page 61, the page before 62, you can see there's a definition about the type of fund balance. I believe your question is about committed versus unassigned, the
Yeah,
committee
okay.
fund balance. Yeah, so those are clarified there in terms of what type are considered committed.
Yeah, so the 15% committed is in that unassigned. But we met it. So basically, before it used to be 15% emergency, 20% operation, which was the 35. We made that operation 20 to 15%. So we meet our 30% set aside within the budget for the year.
Grace, what changes do you see in the audit going forward, given where technology's headed and your work? What can the town do differently in order to make your job easier moving forward?
Wow, that's the first time anyone have asked me such a question, but it's very intriguing. Let me think.
You don't have to respond now. I mean, it's just something to think about, maybe more so than to respond to. But
Yeah,
technology obviously is changing, but
indeed.
when you're ready
Actually,
when you finish one audit, you're ready for the next.
yeah, indeed. Actually, one quick response I could give you is that I've seen great technology impact in terms of ever since the COVID. The COVID forced us into remote, and the remote because of the remote situation, it triggered a lot of technology investment. And just like right now, we are able to Zoom with you, like just like face to face, real time. At the same time, like a lot of documents, many city invested in like remote secure access of their documentation. So we are able to verify the approval, streamline, we can actually verify the streamline approval process of the city's internal control. So it makes the audit, one is much more smooth, reliable, because we can actually verify instead of like just people telling us or paper documentation saying that certain things is approved. The technology allow us to actually verify the internal control via the security login and via layers of approval process. So that's one of the quick response to you. And I definitely think that the technology improvement makes the whole audit process much more efficient and as well as more reliable.
Thank you.
Any other questions?
Yeah, you good? You have another question?
No.
Oh, okay. No, other than that, the staff report, we have a healthy fund balance of 12.1 million. Our unassigned, as we see in the footnote of 6, is 8.2 million. So, it represents 36% of our total general fund operation expenditures for the year. So that's our fund balance is 36% of it. Within the staff report, also just pointed out that we did a transfers out of 4.45 million, and that 4.45 million went to the capital improvement fund. Again, the general fund is the only funding mechanism for capital projects if it's not identified through other special revenue funds or grants. But so that fund balance, if we're not transferring money, it would have been higher, but we're able to still make the fund balance transfers. And you can see that, for this year, you can see the comparisons between 19-20 to 24-25, the fluctuations. But we only have basically 578,000 net deficit when we did those transfers out. And again, in the staff report on page 2 in the top, in addition to the 4.45 million transfer out, we did a transfer in of 800,000 from the employee benefit fund, and that was to help for the offset of the 3 million ADP additional discretionary payment we made to CalPERS. So that 800,000 that 3 million ended up being 2.2 million because, from the general fund, because we transferred 800,000 in there. So you can see, with the general fund, we try to manage, one, our fund balance priorities, but also the priorities of the council and our priorities needs of the town. And so we're able to do these transfers from the general fund and still have a healthy fund balance. If you look at fiscal year 2021, 21, 22, it's like, oh my God, we're in negative deficit. Well, that's when we were building this town center. And prior years to that, we built up our reserves through use of ERAF funds to have the ability to build the town center. In 1920, why are we in a positive 4.4 million? Well, because we received that COP of 6.8 million towards the end of that year, and we used that first to pay for the construction component of the town center. So from 1920 to 21, 22, that's the main construction of this town center. So that's where the general fund weathered that storm. But just to show you, from 22 on out, we're still able to make some transfers out. Being that our revenues are coming in, we're holding our expenditures down and able to manage, some priorities. As we move further into the future, we just have to continue to be mindful of our revenues and then and control our expenditures what we can. And so at the same time, we're able to meet our capital project needs. And again, yes, those do take time, but also they do take a lot of money. And so we're building that up. So that's the highlight of my staff report. But if you have any more questions on the financial statement, feel free to let me know. But
Grayscale, we need to vote on recommending acceptance.
And again, so there's just a recommendation. Staff is just seeking committee recommendation for city council to accept the 24-25 basic financial statements. You have the updated opinion page for the financial statements. As Grace mentioned, it's present fairly non-material aspects of the audit. And all staff is looking for a recommendation to present to the city council to accept these.
Okay. So do we need to have any discussion about recommending acceptance to the council?
Yes.
Would someone move that we recommend the audit report be
we need
accepted by the council?
Move that we accept the audit
Okay.
report,
A
or recommend
second.
the council accept it. I can second.
Okay. All those in favor? All right. Any opposed?
All right.
Thanks, Grace.
Thank you, Grace.
All right.
Appreciate
Thank you so
it.
much, everyone.
Thank you. Have a great
Okay.
one.
Have a great one too. Bye.
Thank you. Bye-bye. No, but these are financial statements. We're still tackling our pension liabilities. They went down. I wrote in the basic financial statements went down about 344,000. Our OPEB we have 1,070,000 in there. So we're lean but mean. In the sense, right? That's all I have. I'm sorry.
Amazing job. I mean, that's the work that goes into.
So the last item is
Thank you.
future meeting topics. Is
My
anybody-
future meeting is gonna be with the council on the budget.
Yes.
The first one is gonna be the first of the month.
Mhm.
Real.
Yes.
Yeah.
3 p.m.
But just for our meetings,
Right.
this one is in May.
Yeah, the next meeting is May 12th, 2020. Yeah, May 12th, Tuesday, May 12th is our regular finance committee meeting. And yes, is a joint study session next Wednesday, April Fool's Day, and it's not a joke. At 3 p.m. And that's a joint meeting with the finance committee. Again, if we don't have a quorum, we can still have the meeting, but it's an opportunity so that it'll be it's noticed as a joint meeting so the committee can do it.
George, you had mentioned maybe a couple meetings ago, about possibly bringing up to this committee a review of
Yes,
just internal controls on park use or something.
Yeah, we need to return those to this committee at some point. So that's a good future agenda item for me.
Okay.
Yep. Credit card use, and then also an update from the joint meeting of all the committees with the council back in February.
Oh, yes.
That was another one I was gonna ask, put on there, so those two items.
You sent me the statements and the monthly, and I haven't worked to those because I thought it's.
Oh, yes.
When we isolate that account, so that may
Yeah.
be something.
Oh, to have another, okay,
I mean, just to say what's the status on that,
okay,
if we're, or even discussing, what that we're doing.
okay.
That would be-
Statements on the PARs.
So that special meeting, Suzanne and I attended, and I think as a result of it, there's going to be some changes to the scope of what this committee is responsible for,
Mhm.
to reflect reality, not to add anything new, I don't believe. But
Right. Correct. So I have those three items. That'll be good.
we ready to adjourn?
Yeah, I think so.
Great.